Roberts, and I'm the Managing Director of Axiom Valuation. I will be your moderator for this webinar. We would like to welcome all of you to the webinar entitled A New Regulatory Direction Using Fair Value Principles to Price Bank Loans and Calculate Loan Loss Reserve Adjustments. There will be presentations from two of our experts and a question and answer session at the end. Please enter your questions under the question tab on the menu on the right of your screen, and we will get to each of them at the end of the webinar. If we do not get to your question during the allotted time for the webinar, we will respond to you individually by email after the conclusion of the webinar. We will also be recording this webinar and will send a copy of the recording to all of the attendees. So today's webinar focuses on the analytical muscle that will be needed to meet developing new regulations that are far from consistent with fair value financial reporting principles for loans and financial securities than has been the case historically. Although the movement to fair value has moved at what can be best termed at glacial pace, the iteration to what we term a fair value principle system is very close to being implemented. While few have any issue with the fair value premise, the issues center on implementation. In the U.S., the SEC is focused on what investors need to adequately evaluate the financial condition of a bank, while banking regulators are focused on risk assessment and too big to fail. Managements of banks are focused on reported earnings being more volatile if loans have to be reported at fair value or something that approximates fair value. The reason is that changes in fair value are run through the income statement and creating more transparent variability and hence lower share prices. Be that as it may, banks and investment already fair value securities on their balance sheets as well as loans that are purchased. The question now is not whether a fair value standard will be adopted, but when and in what form. This webinar addresses many of the issues that financial institutions in Europe and the U.S. are currently facing and will be facing as we move forward. For many of our listeners today, the new reporting requirements, whatever form they take, will create a resource burden for their institutions. They need not be concerned. Axiom Valuation Solution has the human capital, analytical expertise, and reputation with oversight entities that is required to effectively meet an institution's current and future financial reporting requirements. Well, many of today's attendees are clients of Axiom Valuation. I still would like to emphasize Axiom's competitive advantage in the arena of pricing loans and financial securities both in Europe and the U.S. Axiom is the primary pricing agent for publicly traded business development companies, or BDCs, that primarily invest in bank loans. We have been in this space since 2008 and have developed a proprietary analytical capacity for pricing bank loans and related illiquid fixed income securities. In addition, we work with banks on fair valuing illiquid securities in their trading account, including auction rate securities. Dr. Stan Feldman will start the presentation. Dr. Feldman is a recognized expert in valuation and has published many articles and books on the subject. He was a member of the FASB Valuation Resources Group and is the CEO and founder of Axiom Valuation Solutions, and as an associate professor of finance for over 20 years, taught both graduate and undergraduate finance courses. You may read a detailed description of his background on the Axiom website. And then Dr. Thomas Klepsch will take us through the case studies. Dr. Klepsch specializes in developing innovative products and services in the financial industry. He is currently the Vice Chairman of the European Bond Commission and a Senior Consultant to Axiom Valuation Solutions Europe. You can read more about his background on the Axiom Valuation Solutions Europe website. And Axiom Valuation is a nationally recognized financial security and business valuation firm, which is conducted valuation assignments for clients throughout the U.S., Europe, and Asia. Axiom Valuation Europe works with Axiom Valuation to provide a comprehensive range of expert valuation services for business, illiquid securities, fixed income portfolios, intangible and tangible assets, and other hard-to-value assets. Please see our website for more information. And this is our standard disclaimer page. And now I'd like to talk about what the webinar will look at. We'll start out by asking why are the current standards for financial measurement of bank loans changing in Europe and the U.S. We'll talk about the impacts for banks and investment funds. Then we'll look at fair value, economic value, and accounting value and their information contact. We'll look at enhanced information sensitivity of loans and their loss reserve accounting. We'll take you through a case study, go through final thoughts, and then at the end, we'll answer any questions you might have. So now I'd like to turn the presentation over to Dr. Feldman.
Thank you, John. Global financial regulations and financial reporting standards are changing. The financial crisis has focused regulators on measuring systemic risk within the global economy in an attempt to identify the potential for financial bubbles and the degree to which bubble forces are transmitted to various sectors of the global economy. Second, regulators have focused on the need for buffers that cushion the consequences of a financial meltdown. Third, the credit system transmits the forces of a financial crisis through the withdrawal of credit at a time when it needs it most, thereby exacerbating the crisis itself. These factors all point to the need to ensure that the reserve base of credit institutions, most notably banks, are sufficient to sustain a major financial event, and that the raising of reserve base occurs prior to and not during a financial crisis. For banks, this means that provisioning for loan losses is truly countercyclical and that bank capital is sufficient. Put differently, loan loss calculations should reflect the expected credit deterioration, while bank capital should be large enough to deal with unexpected financial developments. Hence, to the extent that IAFMD and FASB move towards a new loan loss reserve accounting standards that reflect lifetime credit expectations, these and bank requirements, for example, Basel Committee on Banking Supervision, will be two sides of the same coin. While loan funds are not required to maintain loan loss reserves on a lifetime expected credit basis, they do in fact do so since assets are measured at fair value at the measurement date. Hence, moving to a new standard for loan loss provisioning effectively means that a bank's balance sheet will more accurately reflect its credit risks. Now, what are the impacts of moving to this new standard? Please move the slide. The first impact are loan loss reserves are created to built upon expectations. Changes in accounting for loans in the bank book. For example, currently banks do not have to reserve for risky loans until there are signs of a loss. Reserve accounting rules were criticized as being too little, too late during the financial crisis. Now, accounting boards have different proposals. For example, FASB's proposal would require a business to look at both past, or a bank to look at both past experience and reasonable estimates of future losses and reserve for those losses the day a loan is originated. The IAFMD's proposal would only make banks consider losses expected over the next 12 months unless a loan's credit has deteriorated significantly. If that is the case, reserves would be made for the full expected loss. Please go to the next slide. The second impact of looking at systemic risk and also being concerned about financial bubbles is the call now for independence. The Alternative Investment Fund Management Directive, or what we refer to as the European Directive, valuation mandate is clear, as the above excerpt from the directive indicates. Independence, functional separation, effectively requires some level of additional resourcing by an alternative fund manager. The alternative fund management directive does not require outsourcing of the valuation function, but does require that prices assigned by the manager meet the positive assurance standard. This means that prices assigned are consistent with what an objective, informed third party would conclude. In short, assigned prices vetted by a third party effectively mean that AIFM has established a framework which meets the independence criterion. Now, independence means that there's a tangible separation between investment decision-making and asset valuation. Next slide, please. Now, the current accounting rules that banks treat loans as well as financial securities not for sale are part of the trading account at amortized cost less impairment, where impairment is based on incurred cost concept, as I've noted or will be noting later. We refer to this as the accounting value. IASB and FASB are not fully harmonized on the calculation of accounting value. The differences are not material, and both oversight organizations are moving to an economic value standard. Now, fair value and economic value are closely related concepts. This is so because economic value is what informed market participants would value the security at using all available information about the security in question at the valuation date. Fair value is the price that would emerge in a hypothetical transaction taking place in a primary market between informed market participants, those using economic value as the basis of the transaction under normal market conditions. Next slide, please. Thank you. Now, some clarification. Now, this slide shows the relationship between accounting value, economic value, and fair value. Some clarification on the differences and similarities between value standards are shown on this slide. Fair value, or FV, is made up of two components: economic value, or EV, and illiquidity. EV is the difference between solvency value, or the value of the loan if one were 100% certain that the owner would receive all contractual cash flows. The takeaway here is that if one can calculate the fair value of the loan, illiquidity aside, one can solve for expected loss, which is the essence of the emerging loan loss standard. Thomas will show this later as part of the case study, but I mention it here for completeness. As can be seen, fair value and economic value are essentially different depending on illiquidity. Market-to-market and fair value are essentially the same concepts for market irregularities, which include the degree of illiquidity being far greater than it would be in a normal market environment. The other assumption underlying these concepts is that a hypothetical transaction takes place in the primary market. Non-primary market transactions are included in the concept of what I term market irregularities. Once illiquidity is removed from the analysis, the value of a loan or any financial security is then based on two factors: credit risk, probability of default, and recovery of expected cash flows, and the base interest rate level. Once one moves to an economic value standard, the value of the loan or security will vary with new information. Under the old standard, this would not necessarily be the case, or I should say under the current standard, this would not necessarily be the case, unless the probability of not receiving promised cash flows was very high. Now, what do I mean by very high? Very high might mean that I'm 70% or 75% certain that I'm not going to receive, for example, my principal back. This would result in an impairment charge that the bank would take. Now, this will not be the case going forward, resulting in bank reserves for expected losses to be both higher than under the current standard and to be countercyclical as opposed to procyclical as it is under the current standard. Now again, what this means is that banks facing expected credit losses don't book those credit losses unless there is a probability, a very, very high probability, normally in the 70-75% area, that those losses in fact actually occur. That's why it's called the incurred loss standard. Next slide, please. Next slide. The book value of a loan on the balance sheet of a bank is equal to its amortized cost less its incurred loss. Incurred loss is what the bank will very likely, as I said, 70%, 75% probability of a loss in the near term. The incurred loss concept essentially states that a loan is impaired if the loss in contractual income and principal is effectively imminent. The use of this concept will generally imply that the book value of a bank's loan book will exceed its fair value. Fair value reflects an exit price where the sale takes place in a primary market under normal market conditions between informed market participants. Throughout this presentation, I'll refer to fair value prior to any adjustment for liquidity unless otherwise noted. While there's some loss in generality by taking this approach, it has the advantage of more easily seeing how moving away from the incurred loss to the expected loss standard yields a loan value that's closer to fair value and thereby making a bank's balance sheet far more transparent than currently. We have often been asked, what is the driving difference between IFRS and FASB? We have a simple answer. The different maturity profile in loans in the U.S. and Europe. As the default expectations are increasing with maturity profile of the loan, the shorter the contractual life of the loan, the lower the required loss reserve, everything else equal. Hence, the difference in the standards in FASB and IFRS may be simply attributable to the different lending practices in the U.S. and in Europe. Since increased contractual life is generally positively correlated with greater default probability, a reserve based on expected lifetime loss would be greater for a typical Euro loan versus an equivalent risk U.S. loan. We therefore expect that expected loss reserve guidelines will not be the same for European and U.S. banks. But what is important here is that in Europe and in the U.S., expected loss will initially be adopted as the principle under which loss reserves are calculated. Note that under the current standards, new information does not alter the value of the loan even when the probability of default changes. Under new standards, this will not be the case. Pushback on proposed standards both in the U.S. and Europe relate to a real concern that if changes in economic value run through the income statement, that this will increase earnings volatility and hence all else equal will have a negative impact on share prices. This concern is real and should not be underestimated. However, stress tests by the Fed and the European Central Bank do measure changes in the equity cushion related to various scenarios, which means stress tests are testing the sensitivity of loan values to various scenario factors. Although FASB does not require that Level 2 and Level 3 fair values be tested for sensitivity, IFRS 13, the fair value standard, in the International Fair Value Standard does require sensitivity of fair values for Level 3 assets. While accounting standards applicable to banks are not identical to accounting standards applicable to alternative investment funds invested in bank loans and illiquid fixed income securities, it is clear that there will be a convergence in the near future. Moving to an economic value standard means that a recurring credit analysis be undertaken with changes in credit quality showing up in loan loss reserve changes. For many smaller institutions, this will be a burden since they are not set up to address such changes on a regular basis. Given the direction that oversight authorities in Europe and the U.S. are moving in, it is clear that financial institutions will need to have a robust analytical system in place to meet both current and evolving financial requirements. What does such a system look like and how can it be used? We answer these questions in the next set of slides using Axiom's credit rating and pricing platform. Just as background, the system will be described, or the system that will be described, has been reviewed by globally recognized audit firms. The structure has been tested for accuracy, and the results have been published in a white paper that has been made available to oversight authorities. Now I'd like to turn the presentation over to Dr. Thomas Klefsch, Managing Partner of Axiom Valuation Solutions Europe. Thank you.
Thank you, Stan. What I like to do right now is to give a short case study how we use our fair value measurement in order to derive loss reserves for banks. Next slide, please. In order to do so, we like to work within the new framework, which requires in the future a different attitude towards the calculation of loss reserves. Loss reserves right now, loss reserves in the future need to be built at the start of the loan, and not only in those cases where the loan shows clear signs of being in trouble. Hence, loss reserves need to take the expected default probability of a loan into account and can no longer be based on experience. But of course, not the entire loan may be lost in the case of a borrower default. The lender may still recover some, if not all, of the principal. Hence, default probabilities and potential recovery value need to be taken into account by determining the loss reserves. This leads us to the starting sentence of this slide. Expected loss reserves needs to be constructed from the default probability weighted difference between the recovery value and the book value of the loan. Our starting point and principal thesis in this presentation is always that the fair value of the loan, this is the money somebody can expect by transacting, which means exchanging the loan against money in the adequate market, contains all the information with regard to recovery value and with regard to default probability, which is required in order to calculate accurately loss reserves in the future regulatory environment. As loans in the banking book are not subject to liquidity assumptions, we need to take the price for liquidity out of the fair value equation. As Stan has laid out, this brings us to the economic value of a loan. This economic value contains all the information the banks need to calculate the future reserve requirements, the default probability and the recovery value assumption. But both are still commingled into a single figure and need to be segregated in order to determine the appropriate amount and accurate amount of loss reserves. I admit that this may sound complex, but a simple example should make the steps crystal clear that need to be taken to extract the accurate reserves requirements from economic value considerations. Next slide, please. To show the relationship between fair value, expected loss reserves, and net loan value, consider the following case. A simple term loan of a corporation within the chemical industry. The loan is rated BBB, is paying the principal at maturity, and it's carrying a rate of LIBOR plus 4%. Long-term observations give us the default probabilities. Here they are 0.52% within a one-year horizon, and they are increasing up to 6.01% within a 5-year horizon, as laid out in the table probability of default. Those default probabilities are risk-neutral probabilities that are backed out of the BBB credit spreads, assuming no recovery value of loan principal. What is clear is that default probabilities increase with the time, and this is independent of the recovery value assumptions. Assume right now that a bank has an investment of 10 million in such a loan. On day one, the loan has a fair value of 10 million. Book value and fair value are equal, while the net carrying value, depending on the recovery value, will be different from the fair value. The underlying assumption is that the underwritten loan could be sold for its book value immediately after the loan was made. This explains the identity of fair value and book value at this point in time. This, of course, may not be the case, and in an illiquid market, it may never be. We will abstract from this nasty real-world problem for the moment to drive home the central point of our presentation. In our example, we just change the recovery value assumptions and see different reserve requirements for these loans. They are ranging from $61,000 in the case of a 30% recovery value assumptions to only $240,000 where 60% of the loan value will be recovered. This is shown in the bottom table, which is titled Initial Loss Reserves Accounting, which should underpin our theoretical consideration that recovery value expectations and default probabilities determine the required loss reserves, and this information is contained within the economic value. Next slide, please. In order to measure the extent to which the loan loss reserve may increase, or put differently, the extent to which the economic value of the loan declined, the credit risk of the loan needs to be calibrated. Axiom's credit rating and pricing platform is a perfect way to measure how financial and economic variables impact the credit risk of a firm and its capital stock. This system has been used by market participants to fair value loans and other fixed income securities, including high-yield bonds and convertible debt. Papers on the system's accuracy have been reviewed by global audit firms and oversight organizations. But now consider that something goes wrong with the borrowing company and its credit standard will deteriorate it. Under the incurred loss standard, the loan loss reserves would not increase despite the fact that the economic value and fair value of the loan has declined, and declined by a great deal. In order to measure the extent to which the loan loss reserves might increase, or put differently, to the extent to which the economic value of the loan declined, the credit risk of the loan needs to be recalibrated. Axiom's credit rating and pricing platform is a perfect way to measure how financial and economic variables impact the credit risk of a firm and its cap stack. This system has been used by market participants to fair value loans and other fixed income securities. Next slide, please. Let us right now look how we are doing our credit assessment. Let us look on a very high level how Axiom is calculating the fair value of the loan. We are taking into account the loan covenant, the competitive position of the borrower, its balance sheet strength and cash flow robustness as reflected by our initial credit rating, and last but not least, the seniority of the loan as expressed in our enterprise protection rating. Those four factors derive the initial value of the loan, which is subsequently adjusted for liquidity assumptions and potential optionality in the loan. The price out of those four factors are straightforward, observable in the market. At the end of this valuation, we are able to derive a fair value which is fully compliant with the enhanced FASB, GASB, or International Financial Reporting Standard. This kind of a value is right now mandatory for all European alternative investment funds. But of course, much more details are available within our white papers on the subject of the Axiom credit risk platform. Let us come back right now. Next slide, please. Let us right now come back to our case study. The initial BBB rating of our loan granted to a chemical company has changed to CCC+ due to a change in the firm's financials or to changes in the market perception of the financial robustness of its business model. Whatsoever, the credit rating has worsened, probably even without the fact that the lending bank may be fully aware. Next slide. But this change in the credit quality has an immediate impact on the loan price. Right now, our credit system tells us that the par value of the loan is 85%, whereby, please remember, at the start of our example, the fair value of the loan has been seen at par. In previous times, banks could have ignored this change in fair value, at least in the banking book. But nowadays, they need to reconsider this loss reserve. They need to consider these changes within the loss reserves for this loan. As the credit quality of the loan has worsened, in our case, there must be more reserves set aside for a potential loss of the principal. Next slide, please. These new amounts and their driving considerations are shown in the following table. The downgrading of the loan leads to a new table of default probabilities. These new probabilities will drive different loan loss reserve requirements. They have increased. They have right now increased from 60,000 in the 0% scenario to close to 2.9 million in our current CCC plus scenario. Or in the case, if you just look at the 60% recovery value expectation, the required loan losses would have increased from 240,000 in our CCC scenario to above $1.1 million in our current scenario. Hence, changes in the fair value of a loan will reflect changes in the credit as well as changes in the embedded recovery assumptions. Both need to be considered in the new regulatory framework for loss reserves. Next slide, please. I would like to summarize my findings in the final slide. First of all, it should have been clear, fair value and therefore economic value contains all the information that is required in order to calculate loss reserves. Recovery value and loss reserves are very closely related. The link is seen in our concept of economic value. This slide shows you in the blue lines the loss reserves for a BBB rated loan under different recovery assumptions, whereby the yellow bars are showing you the loss reserves required for a CCC plus rated loan under different recovery assumptions. The red line and the scale of the red line you find on your right side of this table just shows you how the loan, by which amount those loss reserves have changed within the different recovery value. I'd like now to hand back to Stan for a summary and some final thoughts. Thank you.
Thank you, Thomas. What's the takeaway, I guess, is the big question. The takeaway is that the expected loss concept, as opposed to incurred costs for lost reserves, is essentially consistent with fair value, illiquidity aside. So if I know what the fair value, if I can calculate the fair value of a loan or any financial security, I can then go ahead and compare that fair value to, it's what I termed earlier, its solvency value, and the difference would be expected loss. That expected loss is the basis for the loan loss reserve accounting under the new standard, or will be. So again, the takeaway is essentially that fair value is now a driver for loan loss reserves, regardless of how the bank actually accounts for it in its accounting statements. Some other final thoughts on the subject. I said first, number one would be the financial crisis has had a lasting impact on how we account for and value loans. Second, in order to avoid too little or too late, loss reserves will be based on expected loss rather than incurred cost. Expected loss is based on fair value principles, since its measure is not a bank's idiosyncratic view of the credit, but based on the way an informed market participant would establish the credit risk. Put differently, the same calculus that was used to establish the credit risk at initiation of the loan should be the calculus used going forward. Investment funds holding bank loans and other fixed income securities must fair value their positions, while banks do not. However, under the expected loss model, the following is true. If a bank and an investment fund hold the same loan, then any change in a loan's credit risk will result in the same value change for the loan held by the bank and the investment fund in the absence of any adjustments for lack of liquidity. Axiom's credit rating platform offers a unique and cost-effective solution to measuring changes in credit risk and the resulting changes in economic and fair values. Finally, being able to stress test value conclusions is a key strength of Axiom's system, and both IFRS, the European Directive on Alternative Investments, and bank oversight entities require subject financial institutions to be able to stress test assumptions surrounding the value of the underlying assets. Thank you very much, and now we will open it for questions from the listeners.
Yes, thank you, Stan. If you have a question, please type the question into the box on the menu on the right-hand side of your screen. We'll get to as many questions as time allows and answer the remainder on an individual basis by email after the webinar. So please just enter a question on the right of your screen, and we'll answer it and send you an email if we can't get to it. So our first question comes in when will expected loss become the requirement? So the question is when will it be a requirement to document the expected loss? So Stan or Thomas, do you want to take that?
It's okay. I'll try. I'll take a pass at this, Thomas, if that's okay with you.
Absolutely.
These standards, the expected loss standards, both in Europe and the United States, have been on the table now for probably several years. The addressing of when it will be instituted is, again, been on the table. There's been a tremendous amount of the concept has been advanced by both the International Accounting Board, as well as FASB, as well as oversight entities here in the U.S. and in Europe. And there's been a resistance in general. There's been a pushback, as you would expect, from financial institutions. And as I mentioned, it's not only conceptually complex, but there's a business model involved here that results in potential loss of cash flows or reduced growth rate in cash flows for financial institutions, namely banks. But in the end, over the next 18 months, 24 months, we would expect that the expected loss concept in some form will be adopted both here in the U.S. and in Europe.
So we have another question here. How are banks going to go through each one of their loans to come up with economic values? So Stan, do you want to address that?
Yeah, sure. Well, I think if we just look at the C&I loan book as the example, all of those loans were made using some set of credit risk measures that the bank uses. What we do know is that the issue is looking at each individual loan, and for even a mid-sized bank, we're talking about a great deal of loans, requires that they access information from the clients, rerun whatever analysis they generally do to see whether in fact the risk of the loan has changed in any substantive way, and this requires, no question, it requires work. However, banks do collect information on a regular basis. There is oversight of each of the loans. They do get updated information. So let me give an example. In the case of business development companies which invest in bank loans, they receive information every quarter. We use that information in our models to essentially fair value those loans, and it would be no different for banks. I mean, the number of loans would be larger, but the essential analysis that would be done would be exactly the same. So though the number of loans is large in a bank, the ability now to have platforms like Axiom's to deal with these with large portfolios of loans makes it certainly makes it more efficient. The other aspect is that not every loan has to be fair valued or economic loss done every quarter, but rather you might want to do it on a rolling basis the way, say, BDCs do it generally, where the whole portfolio gets re-rated over the course of the year, but any one particular quarter, 25% of the loans might get re-rated. There are other ways to do this by looking at loans in groupings, namely portfolios of loans that have very similar characteristics, and you get a portfolio assessment as opposed to an individual loan assessment. But all comes down to the same analysis, which is basically has the credit risk changed for the individual loan, and by how much.
Good, thank you, Stan. Well, I don't see any more questions, so we'd like to thank Stan and Thomas for the presentation, and we'd like to thank all the people that attended this webinar. We will be sending copies of the handout and recording to each of you. And thanks for attending, and have a good day.